Under 143 subsection 1, the Companies Act is saying that there are 6 points which auditor needs to verify and report on them. Then 143 subsection 3 says that there are a total of 15 points which auditor needs to verify and report on them. So let us try to read and understand what are those 6 points which are required to be reported under 143 subsection 1. What are those 15 points which are required to be reported under 143 subsection 3. So first we will start with the 6 points given under 143 subsection 1 which are needed to be verified by the auditor and mentioned in the auditor's report. Let us have a look at it quickly. So as per section 143 subsection 1, it is the duty of the auditor to inquire into the following matters. What are they? First point, whether loans and advances made by the company on the basis of security have been properly secured, and whether the terms on which, so let me highlight important terms here, whether they are properly secured and whether the terms on which they have been made are prejudicial to the interest of the company or its members. So what they are trying to say now, first point which need to be verified under 143 subsection 1 is regarding loans and advances. So as you could see here, first point, they are asking you to verify regarding loans and advances, whether loans and advances made by the company. What do you mean by made by the company? Given by the company or accepted by the company? So when they say made by the company, they are actually talking about loans and advances which are given by the company to others. So whatever loans and advances are there, which are given by the company to others, nothing but they are referring to assets of your client, assets of your client company. They are not talking about liabilities. Loans and advances not accepted by your client. Loans and advances given by your client. That means they are referring to assets of your client. So whether loans and advances which are made by the company on the basis of security, if the loans and advances have been given on the basis of security, you need to verify whether they have been properly secured or not. So like for example, you are conducting audit of some client company X Limited, and that client is saying that in their balance sheet they have shown that. So in the balance sheet, so I'm doing audit of the client X Limited. Now, in the balance sheet of the company, I'm able to see some secured loans and advances in their assets. So secured loans and advances, 100 lakh rupees they have given. That is what visible in the financial statements. That is what visible on the balance sheet. Now they are asking you to check whatever this 100 crores of loans are there given under secured loans and advances. Find out whether they are properly secured or not, whether they are correctly secured or not. Like for example, when we call a loan as properly secured, like if you go to the bank for the purpose of the loan, banker will give you loan only after accepting security, no? Like for example, if you have a property worth 1 crore, you have went to the bank manager and told, sir, I have 1 crore worth of property, I will give that as a security, you give me the loan. Will the banker give you 1 crore rupees of loan? Will the banker give you more than 1 crore rupees of loan? No, the banker will give you loan always less than 1 crore, 70 lakhs, etc. He will give. So if you observe, even in our practical case, even in our practical or personal cases also, the loan given by the banker will always be lower than the value of the security which you are offering. So this is what called as properly secured. When we call a loan as properly secured, when the amount of security offered is higher than the loan given, then only we call it as properly secured. So my client is saying they have given loans worth of 100 lakh rupees. So now they should have security for this 100 lakh rupees, 100 lakhs of loan, more than 100 lakh rupees of security should be there. Then only we call it as properly secured. So now I am able to see this 100 lakh rupees of loan was given. I went to the client and told, sir, you are telling these are all secured loans. No, show me what is the thing which you have accepted as a security. Now client has shown me some property. The value of the security itself is 50 lakh rupees. So your client has accepted 50 lakhs worth of security and gave a loan of 100 lakh rupees. You tell me, is it properly secured or not properly secured? It is not properly secured. So we call a loan as properly secured when the value of security is higher than the value of the loan given. So that's what they're asking you to verify as an auditor. If your client has given any loans and advances to outsiders, then you need to verify whatever loans are given, they are properly secured. That means they have accepted a security which is higher than the value of the loan. So that you need to verify. That is what this point is about. So if I read it once again, whether loans and advances which are made by the company, given by the company, if they are on the basis of security, whether they have been properly secured, whether they have a security value more than that value of the loan given. And also one more point they say here, whether the terms on which they have been made, under whatever terms and conditions these loans are given, are they prejudicial to the interest of the company or its members? Now, what do you mean by prejudicial? Prejudicial, you can understand it as harmful, you can say. So, as an auditor, you need to verify under whatever terms and conditions these loans are given by the company to others. Are those terms and conditions harmful to the interest of the company or interest of the shareholders? Sir, when we say terms and conditions are harmful to the interest of the company or shareholders, see, when loan is given without accepting security, loan has been given without charging interest rate, or interest rate is there which is very much lower than the market interest rate, or loan has been given without mentioning any repayment period. So you tell me, these are the terms which are favorable to the interest of the company or members, or which is unfavorable or harmful? These are all conditions. These are all examples of terms and conditions which are harmful to the interest of the company. So as an auditor, I need to verify the loans and advances which are given by the company, if they are properly secured or not. And also on whatever terms and conditions these loans are given, are they prejudicial to the interest of the company? Are they badly affecting the interest of the company or members? Examples of terms which are prejudicial are, so accepting giving the loan without accepting security, or accepting the loans which are without giving any security, and also giving the loans without mentioning any repayment period, without any interest rate, or interest rate which is far lower than the market interest rate. So all these are examples. So this is what regarding first point which auditor need to verify and comment under 143 subsection 1 regarding loans and advances. Now let us talk about the second point, whether transactions of the company which are represented merely by book entries are prejudicial to the interest of the company. So they are talking about the whether the transactions of the company which are represented merely by book entries. Now, what do you mean by transactions represented merely by book entries? See, transactions represented merely by book entries means those transactions which do not have actual substance, which do not involve any happening of the transaction. It is, there will just be a book entry. Those transactions which will have just a book entry in the books of accounts, just an entry will be there, actual happening of the transaction will not be there. So those kind of transactions, we call them as transactions represented merely by book entries. Those transactions which will just have a book entry, they will not have any actual happening of the transaction. Can you give me some examples of such transactions? Just if you give a thought, you will be able to find out. Come on, give a thought. What kind of transactions will be there which will have only book entries but actual happening of transaction will not be there? So as you might have thought of, those transactions are going to be depreciation. Depreciation is just a book entry. No, you just write a book entry. Will there be any actual happening of the transaction? If you are writing depreciation in the books of accounts, are you giving that amount of depreciation to somebody outside of? No. Or even you can take provision for bad and doubtful debts. Even provision for bad and doubtful debts is also an example of book entry. We are just creating an entry in the books of accounts. Actual happening of the transaction will not be there. So like this, as an auditor, you need to verify these entries like depreciation and provision for bad and doubtful debts and various other provisions which are represented only by book entries. Are they prejudicial? Once again, prejudicial means what? Harmful. So whether the entries in the books of accounts like provision, depreciation, etc., are they harmful to the interest of the company or members? Sir, what does that mean? When the transactions represented by book entries will be considered as harmful to the interest of the company. Like for example, a debtor is about to go completely bankrupt. The company is having one debtor. That debtor is about to go completely bankrupt. Not even zero or not even 1 rupee is recoverable from his account. Completely zero recoverability. Now, how much provision should have been created? 100% no. But the client has created, but the management has created only 50% of the provision. Don't you think that is a way of over reporting of the profits? 1 crore debtor is there. He has gone bankrupt. Not even a single rupee is recoverable. Management should have created a provision of 1 crore completely, but management is creating provision of only 50 lakh rupees. That means they are trying to overstate their profits or not? They are trying to understate the expenses. When you have to recognize provision as 1 crore, you are recognizing only 50 lakh rupees. That means you are reducing expenses. That means you are trying to inflate your profits. So this is what they are asking you to verify. find out whether there are any book entries which are represented only merely by book entries, like for example provisions, depreciation, etc. Try to find out whether these provisions and depreciations are shown at correct amount. They are neither overstated nor understated. Provisions, etc. should not have been overstated, they should not have been understated. So this is the second point you need to verify, particularly transactions which are represented merely by book entries. Verify all the transactions which will just have a book entry, which will not have any actual happening of the transaction, and find out whether those transactions are genuine or they are harmful to the interest of the company. Next one. In the case of a company other than an investment company or a banking company, whether so much of the assets of the company as consisting of shares, debentures, and other securities have been sold at a price less than at which they were purchased by the company. This terminology wise, they are making it complicated, but let me try to put it in a simple manner. In case your client is having assets, and those assets are in the form of shares, debentures, and other securities, nothing but financial instruments, stock market instruments, they are having as assets like shares in the company, debentures in the company. So as an auditor, you need to verify whether your client has sold any of the shares, debentures, and other financial instruments at a price less than purchase price. Simple, very simple point. Don't go by the terminology, try to understand the underlying concept here. Whether your client is having any assets which are in the form of shares, debentures, and other financial instruments, and has your client sold the securities at a price less than purchase price. Like take for example, your client is there, so and so fictitious name, some Z Limited. You are conducting audit of some company called Z Limited. Now this Z Limited has invested in the shares of other company. So they have some 1 lakh worth of shares in some other company, ABC Limited. Now this company is selling their investment. What does that mean? Like for example, this company is having shares. They have 1 lakh shares of the company ABC Limited. Now the purchase price, they have bought these shares at 100 rupees per share. This is the purchase price. But in the current year, your client company has sold the shares, has sold all these 1 lakh shares, but the selling price is 90 rupees. At 90 rupees, they have sold it. So now if you observe, your client is that has invested in the shares of the companies, and they have sold it at the price less than purchase price. What is the purchase price? 100 rupees per share. But the client sold it now at what? 90 rupees only. So since the selling price is less than purchase price, this transaction is required to be reported under 143 subsection 1. Understood what I'm trying to say? This is what simply they are trying to say, that whether your client has sold the shares at a price which is less than purchase price. If I have to put it in simple terms, whether your client has sold the shares at a loss. If yes, you need to report it. But they try to say one more point here, one more important observation here. Company other than a investment and banking company, and they're specifically saying that for other than investment or banking company. Now this phrase means that this reporting requirement is not applicable in the case of an investment company or banking company. In case if you are conducting audit of a company which is a investment company or banking company, for that company you need not report on this matter. That means assume you are conducting audit of some banking company like S Bank, you are conducting the audit. Now you came to know that S Bank has sold some shares at a loss. You need not report this point. Why? Why? Because this reporting requirement is exempted for investment and banking companies. Sir, why, sir? What is the logic behind exempting this reporting requirement in the case of banking and investment companies? The logic here is, for the investment companies and banking companies, it is a normal course of business to sell the shares in the to sell the shares. It is a day to day activity for them to sell the shares. So it is quite common, it is their regular business to sell the shares at a price less than purchase price. So that's why this particular reporting requirement is not applicable for banking companies and investment companies. That is what C point is about. So in case of company which is other than an investment and banking company, did you find whether they are having any assets in the form of shares, debentures, or other financial instruments? If yes, whether they have been sold at a price less than purchase price, whether they have been sold at a loss. If yes, report that losses. Next one. Whether loans and advances made by the company have been shown as deposits. See, fourth point is also regarding loans and advances only. And they're saying made by the company. What do you mean by loans and advances made by the company? Given by the company or accepted by the company? This point also they are talking made by the company, which means those loans and advances which are given by the company to the others. Here also they are talking about assets only, not liabilities. So whether your client has given any loans and advances, but instead of showing it as a loans and advances, whether they have shown it as deposits. Your client has taken loan, but instead of showing it as a loan in the balance sheet, they're showing it as a what? Deposits. If yes, you need to report it. First of all, let us try to understand the background why this point has been introduced. Assume that a client has given loan and advance. So as we all know, it is not a normal course of business for a normal company. It is not a normal course of business for a normal company to give the loans. Like for example, giving loans etc. is a normal course of business for banks and financial institutions, which we know. Banks are having normal course of business to give and take the loans etc. So other than banks and financial institutions, for other companies, giving loans is not a regular activity. It is something different. So now assume that a company like Infosys, now, the company like Infosys, assume that in their balance sheet or this company has given a loan amounting to some 100 crore rupees to some another entity X Limited. Infosys Limited, which is not a banking or financial institutions whose regular course of business is software and IT services. This particular company has given loan worth 100 crore rupees to the company X Limited. Now, if the Infosys company shows it as a loans and advance, now, this will get the attention of so many shareholders. So many people will get the attention. They will get a doubt if they have been shown it as a loan in advance. Now, the people will get a doubt that Infosys is not a regular, Infosys business is not giving loans and advances. Then why they have given this loan of 100 crores? To whom they have given? For what purpose they have given? What is the repayment schedule? So, a lot of questions will be asked from the management. If Infosys company has given loan to some others and this loan was not disclosed, if this loan was shown as loan and advance in the balance sheet of the company, this will raise so many questions from the stakeholders. Board of directors are answerable a lot. They have to answer why they have given this loan, for what purpose they have given the loan, for how much period this loan has been given. So many people will keep on asking you the questions. Now assume that this company doesn't want to have this company doesn't want to face all this headache. They don't want to be answerable to anybody. So now what this company can do is they have given loans and advances, but instead of showing it as loans and advances, they have shown it as a fixed deposit or something, some deposit under the deposits account. See, both loans and advances and deposits both will come under asset side of the balance sheet only. It will not have any impact on the balance sheet. Either you show it as a loan and advance, either you show it as a asset, both will come under us. Either you show it as a deposit, both will come under assets category only. Your balance sheet will tally. Your impact will not be there on the balance sheet. So that's why what company will do is they will give the loan, but instead of showing it as a loans and advance, they will show it as a deposits. Sir, if the amount is shown as a deposits, will it not get to the attention of the stakeholders? Generally, no. Stakeholders generally will not pay attention to the section called deposits. Why? Because deposits are something which are in the ordinary course of business for every company. Like if you want to take a property on rental deposit you have to pay. If you want to make credit purchases from the creditor, he will ask you security deposit. If you have excess money, you can go and invest it in the fixed deposit. So deposits are something which will happen in the ordinary course of business for every company. Shareholders will not pay much of attention to these deposits. So management wants to utilize this. They have given loan, but in order to avoid the shareholders' questions, they might show it as a deposits. Why? Because if you show it as a deposit, no one will ask you questions about it. Why? Because they will believe that deposits are something which are in the ordinary course of business. So like this, management can play this kind of tricks to deviate the shareholders. Okay, shareholders might not be able to find it out, but as an auditor you will be able to find it out. No, so that's why they are asking you to verify whether your client has given any loan in advance, but instead of showing it as a loan in advance, to mislead the shareholders and stakeholders, have they shown it as a deposits? If yes, report what are those loans, what are that loans and advances, how much amount has, and how much of such loans and advances amount has been shown as deposits. That you have to report it under 143 subsection 1 of the Companies Act. Clear, everybody? So fourth point is also regarding loans and advances given by the company, whether they have been shown as deposits. Hope everybody is clear about this discussion. Now let us come to the next point, E point, whether personal expenses have been charged to revenue account. Now what does this mean? This means that There are some personal expenses are there. Whose personal expenses? See, a company will not have personal expenses. A company will not go on vacation. A company will not eat food, etc. So when I say personal expenses, I'm talking about personal expenses of management and employees. So whether personal expenses have been charged to revenue, whether personal expenses of management and employees has been shown as a business expenses, you need to find it out and report. So as an auditor, you need to find out whether your client has recorded any of the personal expenses of officers and employees as business expenses. If yes, you need to report it. Now, what does that mean? Let me give you a few examples. So assume that there is some company X Limited, or there is some company Reliance Industries Limited. Now in this Reliance Industries Limited, one of the board of directors is that this board of director has traveled to US, and for the purpose of travel is he want to meet a client there. Board of director of the company Reliance Industries Limited, he went to the US for meeting one customer for a business meeting. A board of director went to the US and came back. Now, for the purpose of this travel to the US, his accommodation and stay and all, the amount came to somewhere around 4 lakh rupees. Will this be a business expense or will this be a personal expense? The board of director traveled abroad for attending the customer's meeting and he has incurred some 4 lakh rupees of money on that. Can it be shown as a business expense or is it personal expense? It is a business expense only. It can be shown as business expense. It can be charged to statement of P&L. Why? Because board of director is traveling, but for the company's work only he is traveling. Now, assume that the board of directors of Reliance Industries Limited, he has taken a flat on rent in a rich gated community. In some gated community, he has taken a flat, and per month he is paying a rent of some 5 lakh rupees. Very spacious flat in the rich gated community he has taken. 5 lakh rupees per month rent he is paying. 5 lakhs into 12 rupees, 12 months, 60 lakh rupees of rent is paid annually. And in that flat, board of directors, that concerned board of director, along with his family, he's staying there. For his accommodation, he has taken that flat. 5 lakh rupees of rent per month. For 12 months, that rent he is paying 60 lakh rupees. And all this 60 lakh rupees of expense for this board of director has been shown as a business expense. That means it has been shown in the statement of P&L. Is it acceptable or not acceptable? Board of directors taken an apartment in a rich gated community, paying 60 lakh rupees of rent per year, staying with his family, enjoying his stay there. Will that be a business expense or personal expense? See, here we can't directly say. Why? Because here we need to understand the policies of the company. See, some companies will have a policy that a company, Asian Reliance Industries Limited, is having a policy that board of directors salary, their remuneration includes as a part of their salary, the company will even bear the accommodation expenses also. The company has told as a policy at the time of recruiting the board of directors, they have to give him salary. No, that employee agreement says that company will give him salary, along with that company is responsible for accommodation of the board of director also. So now if the employee agreement is drafted in this manner, that company will bear even rental expenses also will form part of package. Yes, if there is such a policy, that can be treated as business expense. But when you open the agreement with the board of director, there is no specific thing mentioned regarding rental, etc. They have told only the board of director will be entitled for salary. Nothing was mentioned about whether the company will bear the accommodation or not. Now it will be a personal expense. So if this is the case, and if the 60 lakhs is getting incurred by the board of directors on the flat rent, now if this is shown as business expense, this is wrong actually. And as an auditor, you need to report it under 143 subsection 1. Understood, everybody? So as an auditor, they are asking you to comment whether personal expenses have been shown as business expenses. Let me give you one more example. See, here I have told this board of director has gone to abroad for attending a client meeting. For that 4 lakh rupees he has incurred. But while he is coming back, he has bought some 4 iPhones as a gift for his family. So some 4 lakh rupees worth of iPhones he has bought, and total 8 lakh rupees has been claimed as business expenditure. Is it permitted? Now it is wrong. Why? Because only 4 lakhs is business expenditure. To the extent I know, no company will have a policy they will sponsor the gifts for their families also. I don't know any of such company. So that's why this 4 lakhs only should go to business expense. This 4 lakhs should not be charged to the statement of P&L. Clear? So as an auditor, they are asking you to verify whether any personal expenses of the management or employees, whether they have been shown as a business expenses, which should not happen. Next one. Let us come to the one more last point under 143 subsection 1, which needs to be verified and reported by the auditor, where it is stated in the books and documents of the company that any shares have been allotted for cash. That means whether your client has allotted the shares for cash. Can the companies issue the shares for other than cash also? We all know shares will be allocated for cash. But is there a possibility shares can be allocated for other than cash also? Yes, there is. Sir, what are examples? Examples are companies issuing shares as a settlement to the debtors, as a settlement to creditors, sorry. Like they are having some creditors, they are unable to pay the creditors. As a part of settlement to the creditors, shares can be issued. Now, this is the case of shares issued for other than cash. Or assume one company is acquiring another company, amalgamation is happening. As a part of purchase consideration, shares are given. Like for example, Facebook company acquired WhatsApp. Now when the Facebook company is acquiring WhatsApp, they did not give all the money in cash. Purchase consideration, assume some $1 billion is a purchase consideration. This entire 1 billion was not given in cash. Facebook company would have given shares of the company as a settlement for purchase consideration. So here also you are issuing shares not for cash, you are issuing it for settlement of purchase consideration. So the point which I want to conclude here is the companies will issue shares. Shares can be issued for cash also. Shares can be issued for other than cash also. Now here we are not talking about the second case. The particular 143 subsection 1 is talking about only the first case. That is whether your client has issued the shares and from that shares whether they have collected the cash. So if the shares are issued for other than cash, that is not a subject matter under 143 subsection 1. They are only talking about whether your client company has issued the shares. That too for cash. They have to collect the cash for that, not as a settlement. So let us see what they are trying to say here. Where it is stated in the books and documents of the company that any shares have been allocated for cash. If yes, whether cash has actually been received in respect of allotment. So find out whether your client is saying they have allotted some shares for cash. Now what they're asking auditor to verify, they're asking you to verify whether cash has been actually received or not. And if no cash has actually been received, whether the position as stated in the accounts books and the balance sheet is correct, regular and not misleading. Very simple point guys. The sentence might look lengthy, but the concept is very simple. First find out whether your client has issued any shares for cash. If yes, verify whether all cash has been received by the company or not. If all the cash is received by the company, well and good, no issue. Yes, the company has received all the cash, perfectly fine. In case if the cash is not received, then you need to verify whether the position stated in the books of accounts is correct and not misleading when cash is not received. Like you might have done it in the accounts, accounting for share capital. Assume a company has called up the capital, called up the calls, but some person did not pay the calls. Now, how it will be recorded? It will be recorded as calls in arrears in the balance sheet. No, it will be shown under share capital heading. So that's what they are saying. If entire cash is received, well and good. If cash is not received, these kind of accounting entries are correctly recorded or not. Like if cash has not been received, calls in arrears entry has been written or not. So if cash is received, well and good. If cash is not received, that thing should be correctly stated in the financial statements. It should not be misleading. Like if some shareholder did not pay the call money, calls in arrears has to be shown. Understood everyone? That's what the simple point here. Check whether your client has issued any shares for cash. If yes, whether cash has been actually received. If the cash is received, well and good, no problem at all. In case if the cash has not been received, then we need to check the position stated in the financial statements. It should be correct, regular, and also it should not be misleading. Clear? So these are the 6 points which are required to be verified and reported by the auditor in his audit report. And which section has given the 6 points? 143 subsection 1 has given the 6 points. So what are they? Let us have one quick recap once. So first point is regarding loans and advances. Find out whether your client has given any loans and advances to others. If yes, whether they are properly secured, and also whether the terms and conditions on which such loans are given, are they prejudicial, are they harmful to the interest of the company. Even I gave you examples when the terms and conditions will be considered as harmful. That is the first point, talking about loans and advances. Second point, whether the transactions which are represented merely by book entries. What do you mean by transactions represented merely by book entries? Only book entry will be there. Actual happening of the transaction will not be there. Examples of that entries: depreciation, provision for bad and doubtful debts. So second point, they are saying whatever provisions etc. have been created in the books of accounts, are they harmful? That means are they either overstated or understated? Nothing should happen. The provision should be calculated at correct amount. That you need to verify and comment. Third point, in case if your client company is a company other than investment and banking company, whether such a company has sold the shares at a price less than purchase price. In simple terms, whether your client company sold the shares at a loss. If yes, you need to report it here. Fourth one, whether loans and advances which are given by the company instead of showing it as a loans and advance to mislead the stakeholders have been shown as deposits. Fifth point, whether personal expenses have been charged to revenue, personal expenses of officers and management, whether they have been shown as business expenses in the statement of P&L. And finally, whether your client has allocated the shares for cash. If yes, cash has actually been received or not. And in case if the cash has not been received, the position stated in the financial statements and books of accounts should be correct, regular, and it should not be misleading. So these are the 6 points. Like this, under 143 subsection 3, we have altogether some 15 matters are there which are required to be reported. So what are those 15 matters which are required to be reported under 143 subsection 3? That we will try to understand in our next session. Hope you are all able to understand.